Let's take a look at cash management. Most firms are actively involved in attempting to keep cash to a minimum. That may be surprising to you, but cash itself doesn't earn a return. We would rather have our assets invested in properties that will earn a return. So longer term investments. Cash is necessary because it's our transactions that we engage in are in cash, but we don't want to have any more cash sitting around than we have to. It's critical to have cash in part because cash is needed to bridge us through emergencies, and in the during the latter part of the 2000 decade, there was a significant recession. Firms that didn't have enough cash on hand found that they also weren't able to borrow from the bank, and it led to severe problems. Having said that, you don't want to have more cash on hand than you have to. You want to minimize those balances, and to do that, you need to have an accurate knowledge of how cash moves in and out of the firm, be able to make good projections of that. There are several reasons for holding cash. The most important usually is a transactions motive, which is to say we have to pay our suppliers in cash. We get paid by our customers in cash. In order to pay our employees, pay our suppliers, we need cash available. And so that's a transactions motive. There is also the case where in some cases we might have compensating balances with banks. A compensating balance is a mechanism by which the bank keeps some of our cash on hand that they can then use to lend out to other parties. We don't pay a fee, but we're foregoing the use of that cash for some other activity. So a compensating balance at a bank, in order to enjoy other banking services, might be one of the motivations for holding cash. And then precautionary needs motive, which became very important in, say, 2008, 2009, when the banking sector didn't function as well as it had over the prior decade. Firms that didn't have enough cash on hand found that they couldn't get loans either, and obviously that's a severe problem. Let's consider the cash flow cycle. Now, there are two illustrations in the text. This is the expanded version. We'll start at the top. Obviously, in the first step here, customers pay for or purchase items, and we're selling at that point, and when they do that, cash typically comes in. If cash comes in, that adds to the cash balance. Sometimes it's less direct. A sale will produce an accounts receivable, and then when we collect the accounts receivable, which might be over a month or several months, when that collection occurs, then we get the cash. So in either of those two scenarios, the sale eventually leads to an increase in cash within our firm. What does the firm do with that cash? Well, it operates its business. Several of those, several different mechanisms are used for that. We have to purchase materials and services. We have to pay for labor. We have to pay for raw materials if we're producing inventory. That materials, as cost of goods sold, then turns into inventory. Sometimes a firm might buy its inventory directly, not be manufacturing inventory, but buying all of its inventory directly. But in either instance, there's a use of cash at that point. And that cash and that inventory, though, then turns around and becomes part of the next sale. So there's the circle is from sales to accounts receivable or cash. The cash is then used to buy further services and inventory. Those further services and inventory turn into later sales. So that really is sort of the first piece, and I'll just box all that off with a blue line. Having said that, cash is used for a number of other things, and we see those things. We've got 4 little boxes down here for other uses of cash. And let me clean up just a moment here. There we go. If a firm believes that it has sufficient cash on hand to meet all of its transaction requirements over the short run, it might invest some of that in marketable securities. And so marketable securities are assets that we can very quickly turn back into cash if we need to. And so you see our little arrow going both ways here. Sometimes we're investing in marketable securities, other times we're liquidating marketable securities in order to turn that back into cash and use the cash to run back through the cycle again. The same thing, in the same way that we have marketable securities, we might from time to time borrow from our bank, in which case, as the little blue line indicates, borrow from our bank, cash comes in, but we have to repay those loans from time to time and cash goes back out again. So we may borrow from commercial banks, we might borrow from other non-bank lenders, but it's marketable securities are an asset that we might buy and sell, and these other payments might go to pay off liabilities or to incur liabilities. In addition, there are a couple of other there are claimants other than our lenders who require payment from time to time. One is the government. We have to use cash to pay our taxes. They don't send cash back typically. If they do it in the form, more often than not, of being a customer. Governments buy goods as well, but in general, the cash goes one way. It goes out to the government. And finally, we make payments to our shareholders in the form of dividends. While the firm may from time to time raise additional capital through secondary offerings, in general, that's the payments go from the firm out to the customer. So that really is the entire expanded cash flow cycle. The incorporating the customer, production of new inventory, new goods, running it through the sales cycle, and then using cash also to managing cash by purchasing marketable securities and asset, or paying off loans, which are our liabilities. A firm may have both, and then the cash is used to pay interest and dividends and to pay taxes as well. In the next section, we will turn our attention to how financial managers actually structure collections and disbursements in order to maximize firm value.